Let's see, I guess I have to click here first to go. All right. Um, and I do want to reiterate, guys, I do not have multiple screens. I am sitting in a small private office somewhere away from my home office. Um, at home, I have to be on a satellite because I am in what is called the boonies here, even though I'm basically an hour outside of Seattle. I'm in a river valley, and I do not have DSL. I do not have Comcast. Much as I've tried to get either one of them, I can't where I live. So I'm kind of stuck with what I have in technology. I also have to be mobile, and I have a laptop. It's about 17 inches in the screen. It's pretty heavy. It's luggable more than a laptop. So that is my technology platform, and I do it all on this. Okay. So first of all, start learning this approach with very small amounts of money. Specifically use micro lots, which is my recommendation to you, or stay in demo till you get the hang of it. Prove to yourself that you can learn and follow the parameters, not deviating from them first, and then prove your success to yourself with at least 20 consecutive trades, as it does nobody any good if you jump in with both feet and sustain unnecessary losses. And you will have my spreadsheet so you can start keeping track. 2 micro lots means there's absolutely no thinking about money at all. You're simply concentrating on the trade. You want to move out of one lot at the first target and leave the other one to be managed at the second profit level of 20, 30, or plus pips, depending on the volatility of the pair. And there was a question about how do you tell the volatility? Well, that is by your average daily range, and you'll get a feel for it. If your average daily range is less than 100, you've got a rather low volatility pair. And if it's over 200 or 300, it's a pretty active pair. Okay. These are not, for the most part, trades where you want to let something ride for larger gains, unless you see that it's a MACD divergent entry in the correct direction, or some other method that you believe might have larger possibilities attached to it. These are usually just counter trend trades, and they will give you a limited amount of profit. And I've tested that, and I usually lose more than I could have gained by simply taking the trade off near the base of the swing used for the entry, or top of the swing, or the support and resistance level on the 5 or 15-minute chart that makes sense around pivots or whatever. Getting greedy doesn't pay more with these London close trades. You will get stopped out more often and lose more pips than you will gain over time. So once again, close out one lot at a clear level and perhaps let the other one run. And if by chance you have a 2-for-1, I'd close the trade or manage the stop really closely. And as part of this webinar, you're going to be provided with the advanced strategies as an additional recording. I introduced that section here only because some of you are already thinking, and I could tell from the questions that I was fielding, that you see more opportunities for additional profits and or areas where you might be able to limit losses or exit trades. In that recording, I will show you what I've learned to do to enhance the profitability of this system. But when you start trading this system, start with the basics first. And the reason I introduced that advanced strategies now is in preparation for this example. You might ask, why didn't I take this first entry? Okay, and you probably have already noticed this large early swing, this being the ADR. And here are some of the levels that I've marked on the chart that I've watched from higher time frames. I waited on this one because of the size of that swing being 64 pips and early. Okay, so I waited. This was very early in the London close time frame. Now, I do have a strategy where I could have taken that and then added to it, but you'll see that later on. I chose not to on this particular example. This was a Monday. This was the very first day after daylight saving time was back in sync between the UK and North America, and I decided to wait and see what was going to happen, and therefore I took this second entry right here. Actually, this line is a little off. It should be right here, okay? And my stop is, these lines are just down about 5 pips from where they belong, so I'm sorry about that. We've tried to correct all the slides and make sure that they're right. I use IntelliCharts with an MVT feed for all of my charting. I actually trade through an MT4 platform, and I have 3 different accounts that I trade through, okay? So with that, let's see here. Oh, I'd marked off my levels and noted the first swing down, which influenced my decision to either take the entry at the support level or pass on the trade in this instance. I could have even waited longer to exit the trade at the close. As you can see up here, here's the close of the window for the London close trades. I could have waited here. There's a pivot. There's clear resistance, but I didn't. I closed it here. And, you know, as time moves on, I forget sometimes what I might have been doing that day, but other meetings come into my life and other things I have to do sometimes right in this time frame. So you will see some of my entries. I just plain close them out because I have to go do something else. All right. I work hard to keep emotion out of my trading. And when you know me, or you may get a feel of maybe my background from my picture, but I try to just say next when I miss a good setup. I can't say I'm the even keel person that lots of other people are, but I work hard on it. And I follow my parameters as closely myself as I'm presenting them to you here in this course. However, sometimes I miss a great setup and or fail to set alarms or set alarms at slightly the wrong place and or do things that all traders sometimes will do. And that's life and that's trading. Okay, and I do have interruptions. Can't always control those. So I try. Um, at the same time I was managing this trade, I was managing the euro yen in the example we just looked at. I set my alarm here, as you can see it. This is the price alert here, okay? And my ATR was 180. So 15% of ADR of 180 is 27. I set this exactly at 27. Dumb, okay? Here's a pivot, here's support. I should have had my price alert down here to alert me that I was getting close. And this swing made it to 26. Now somebody was asking if I follow my rules to the absolute pip. I would have taken this trade. That's pretty darn close. Okay. In my book, that's pretty close. And I probably would have taken that trade. However, um, you know, I missed it. Here's a great entry. And it ultimately would have been a profitable trade. When you get done with this section and you go back and look at my spreadsheet, you're going to see that if I had gotten all the trades I missed, it would have been even so much more. Really, I would have had over 4,000 pips. But I missed a lot of trades. Sorry about that. On this
That's
day,
okay.
U.S.
That's okay. Well, I missed the value one.
Yeah, right. You probably got this one, Vic. But U.S. equities were mixed. Ultimately, the market closed down about 37 points. Gold was breaking through 1,400. It was a Monday, and I know a lot of you don't trade on the Monday. And the U.S. Dollar index had barely made its range. And I was watching for the exact pip. Sorry about that. All right. Moving on. And kudos to Vic for making these charts much more clear than what I had on the captured examples that I had done in the first place. But I think we talked a little bit about the US Swissy and sometimes why we wait. This is a classic trade example. In this one, the stop was 15 pips. The fill was right here, and we're going to talk more about this, but you'll notice that this is a pivot right on top of the 62%. And the fill was right there at 95.82, okay? In this case, and not in all of them, I will trade at the 62%. And this is part of our tips and tricks, and I'm going to introduce it early with this example because it's here. But if you see a pivot and you see a previous support at that level, take the trade here. Don't force it to come down and try to take you in here because you're going to miss it. And this day, the US dollar index had met its range. Price was moving up nicely. There was a clear level of support here. So I actually took my first profit with 20 pips instead of 15, which I normally would do on this pair because of this level of support here. And then I took the balance of it out at the 30 pips to double the risk. Okay, and sure, it went on up. And we will revisit this example later on in the advanced strategies. So for those of you with great memories, just remember this little spot here. We will see this chart again. Okay. And on this day, the Beige Book news was coming out and was to be released about 1 hour after the close of this time frame here. So I was a little nervous about staying in, but I shouldn't have been because price usually will just consolidate ahead of a major news announcement, and I could have probably taken more profit. but I didn't. That's the way it goes. On this euro-yen pair on the 29th of October, this could have been much more profitable had the trade been closed closer to the end of London time frame, as you see over here. Here was my expected target, and you can see why from this level of resistance that I was watching, but it didn't quite get there. And you can see here how I've moved up the stops. I sometimes put maybe too much verbiage on my charts, but if you come back to this recording and study it a little bit, maybe it'll make more sense what I was doing. I've tried to make some notes sometimes about things that were happening while I was in the trade, okay? But the point here is don't try for the ultimate target. If you're past this time frame of 1300 hours New York, or 1 p.m. New York, you might just want to close the trade, especially if you're sitting on a pivot, okay?